And welcome to the Aaron Katsman Show. I'm your host, Aaron Katsman. We speak about your life, your money, and your investments. And as always, we're coming to you from the spiritual and soon-to-be financial capital of the world, Jerusalem, Israel. If you like this content, please hit the like button below. And if you've not yet done so, please, pretty please subscribe to both our YouTube channel and to the podcast. So I came across a really good article by Ben Carlson, who is a CFA, and he's also portfolio manager for Ritholtz Wealth Management. And he writes an article titled, "Are the Markets Stacked Against the Little Guy?" I'm going to read a little bit about it from his article, and then I'm going to go off on my own little tangent. Our reader asks, he says, "Can you speak to if you think the market is skewed towards benefiting the large players more than the small players, if not being downright rigged against the small players?" He answers, "There's a movie coming out this fall about the GameStop saga called Dumb Money." Now, I did a podcast a while back about GameStop not being a retirement plan. So you can find that on the channel and listen to that. But he writes, "Pretty good cast here. Seth Rogen, Paul Dano, whatever, going on and on, as all the major players. Based on the trailer," he says, "it looks like a movie about the stock market being rigged against the small players and in favor of the big whales like hedge fund managers Ken Griffin, Steve Cohen, and Gabe Plotkin. But this story is about how a little guy took on the big guy and won. A real heartwarming tale. I'm sure the movie will be fine, if not a little embellished, but the premise is a tad bit flawed," he says. "Yes, the little guy did win. In this case, Roaring Kitty made millions on his GameStop trade, and Plotkin was forced to shutter Melvin Capital after losses mounted from shorting GameStop shares. David took down Goliath. The problem is Goliath is still doing pretty well for himself these days. I saw the following headline last month. Michael Jordan is selling his majority stake in the Charlotte Hornets for $3 billion. Wait," he says, "who owns a majority stake in the Charlotte Hornets? Plotkin is now a majority owner of an NBA franchise. He's probably still worth hundreds of millions of dollars even after the short squeeze debacle." I'm guessing that part won't make it into the movie. This is all Carson. Now he continues. This is what I really want to get to. The problem with hedge fund fees is they don't get clawed back if your fund blows up. Sure, he was humiliated by a bunch of Reddit traders, but still walked away with all that money. It feels like heads I win, tails you lose. So are the markets really stacked against the little guy? This is where it gets interesting. In some ways, yes. You're never going to get sweetheart deals from Goldman Sachs or Bank of America like Warren Buffett did during the financial crisis. You'll never be able to invest in the best hedge funds, venture capital funds, or private equity deals. You're never going to earn a 2% management fee along with 20% of any profits on your investment ideas. If you try to take on Ken Griffin in high-frequency trading, he's probably going to win regardless of what happens to your position. Wall Street will always have better technology, research capabilities, and access to people or deals than you. Now, I want to stop for a second. This is so true. And that's why all the statistics show, and he's going to get into this, that it's almost a fool's game for individual investors to start trading stocks, right? You're never going to have the advantage that the head honchos on Wall Street have, right? And they get the information, even if it's a nanosecond before you, in many instances, that's going to be too late. But, he says, in other ways, the individual investor has all sorts of advantages over Wall Street. You get to invest in index funds if you want to at low fees that basically guarantee you'll outperform at least 75 to 90% of professional investors in the stock market. Yet you get to ignore short-term performance numbers. You don't have to worry about how your portfolio looks compared to some short-term benchmark. The only benchmark that matters for you is whether or not you achieve your financial goals. Now, that's where I want to stop, right? He goes on and on talking about how Wall Street is fixated on short-term performance, right? We live day to day and quarter to quarter. And that's really bad for individual investors, right? You've heard me write about this a lot. You've heard me speak about this a lot, right? Success for individual investors isn't based on your performance versus some market benchmark over 3 months, 6 months, or 12 months, right? It's a long-term process. And ultimately success is if you invested your money and you were able to achieve your goals and hit your needs, right? And what will I say about that is I always do. Those are moving goalposts, right? When you're 50, your goals and needs are going to be different than when you're 60, and those are going to be different when you're 70, and those are going to be different when you're 80, and so on and so forth, right? So it's not just about performance. Too often, the financial media is fixated about performance. They say, well, just, you can do it yourself and, invest yourself. And, it's all about save a little bit of money in fees and do it yourself and you'll do better, better, better. But what is better? And do people always necessarily have the information to create a portfolio which is suitable for them, right? For their specific situation, their goals and their needs, not somebody in some ivory tower who's writing down to the readers and saying, this is what you should and shouldn't do. That's not how it works in this business, or at least it shouldn't. Okay, I see too often there are people out there who are quote unquote consultants and they're pitching people, open up low cost accounts and just, invest for the next 50 years in ETFs. Now that might be some kind of a strategy, but there's more to it than that. Okay, what are your goals? What are your needs? It's not just about hoarding as much money as humanly possible, because you don't get buried with your money, right? The money is there to serve some kind of a purpose, whether it's, marrying off your children, whether it's retirement, whether it's, buying a boat, whatever your goals are, that's what the money is there for. It's not to necessarily outperform the S&P 500, right? Which is random, right? Why that's the benchmark, I don't know, right? But that's what they've sold us the benchmark as being, right? You got to do better than the S&P 500. Why not mid-cap stocks? Why not global stock indices? Like, why S&P 500? I don't know. But that's what they tell us. So that must be the truth, right? It's not, right? Success is not measured versus the S&P 500. It's measured versus your own goals and needs. And as I say, those things change over time. And that's why it might behoove you to use a professional, because they're able to actually handle the discussions with you and see whether or not your portfolio should adapt as you go through life, as opposed to doing it on your own, where maybe you're not 100% equipped. You don't know what's out there necessarily in terms of different types of assets to enable you to create a portfolio that will both manage your risk and enable you to achieve whatever it is that you're setting out to accomplish. You've been tuning in to the Aaron Katsman Show. We speak to you about your life, your money, and your investments. If you like this, hit the like button below. I'm sure some of your do-it-yourself guys are not going to like this, okay? But you know what? We're brave, and we're gonna turn on the thumbs down, okay? We're not going to turn off the comments like some people do. If you like this, again, hit the like button below. If you've not yet done so, please subscribe to both the YouTube channel and to the podcast. Thanks so much for tuning in, and we'll speak to you soon.